Welcome to How To Videos Unlimited. This is the 7th step in the How to Get a Car Dealer's License series. And today we're going to be talking about the different business entities. And I got a special guest, a business expert that's going to go ahead and cover this section of step 7. So without further ado, let's get right into it.
Okay, thank you and welcome. Let's talk about how to get a car dealer's license. Step number 7, choosing your business entity. So we're going to review some types of business entities for small businesses. These include sole proprietorships, partnerships, limited liability companies, LLCs, C corporations, and the S corporation. So what are some factors for choosing your organizational type? First, you're going to want to think about taxation. Taxes on profits are paid through personal tax returns, except for corporation. You're going to want to consider liability and risk. This is the responsibility for harm to another person or property or contract dispute. How much liability do you want to incur and what types of risks are you comfortable with? Management and decision-making authority. How do you want to manage your company and who do you want making decisions? Continuity and transferability in running your business under its organizational type. So first, let's take a look at the simplest form, which is called the sole proprietorship. Sometimes this is also called a fictitious business name, FBN, or a DBA, doing business as. In this case, the business is one and the same as the owner. There are some advantages and disadvantages to the sole proprietorship business type. The owner has unlimited personal liability. So that means that the owner can be personally sued for all of their assets, including their home, their savings, their bank account, for any liabilities, debts, or problems with the business. It's also considered a pass-through tax entity, meaning that the sole proprietor, the owner, reports profits on their personal income tax return and pays taxes on it as if it was personal income. The owner, however, does completely control the business. This is the simplest form of organization and the easiest to create. In general, what you're going to do is go to your county clerk recorder's office and you're going to file some sort of fictitious business name statement or doing business as statement. You're going to publish that in a legal newspaper. They're going to give you a list of newspapers where you can publish. And within about 4 weeks, you'll be a legal sole proprietor with a designated business name within your county. And this is generally the lowest cost to form. You don't necessarily need an attorney or anyone to help you. You just file a form with your clerk, pay some fees, have it published, and you're done. This is generally appropriate for small startups that are not incurring too much liability in the beginning of the creation of their business. Second, we have general partnership. Now, the thing to remember about a partnership is that you do have to have 2 or more people to have a partnership. If you just have one person, it's automatically going to revert back to that sole proprietorship. And that's because in order to have partners, we have to have 2 or more people. So business, again, is one and the same as the owners, the partners. And there are advantages and disadvantages to consider with the partnership model. Again, under a general partnership, the owners have unlimited personal liability. And this is often referred to as joint and several liability, meaning that they can sue the partners for everything that they collectively own. So all of the partners are going to be responsible, including their savings, house, property, cash, bank accounts, anything that they own could be pierced and taken in the case of a lawsuit. Again, this is going to be passed through taxes. There's the partnership profits are going to be reported by each partner on their personal income tax return, and it's going to increase the amount of their personal income taxes that they pay at the end of the year. The partners, who are the owners, do have absolute and complete control over the business. This is another simpler form of organization. You don't necessarily need a partnership agreement, form a general partnership. It is recommended so that you put things in writing up front before there are any disagreements between the partners, but it is not required. And again, this could be appropriate for a small startup business when there's 2 or more people going into business together, they might want to form a general partnership. Next, we have what are called limited partnership and limited liability partnership. Often you'll see these denoted as LPs or LLPs in the name of the business. So some of the advantages and disadvantages of this form: the general and limited partners are again going to run the business. However, the general partner is going to be running the day-to-day operations of the business, and the general partner is going to incur the personal unlimited liability for the operations of the company. So again, that general partner is going to have all of their money, assets, their house, their checking, their savings at risk for any liabilities of the business. The limited partners in this situation do not have their personal assets at risk. They only have their investment into the partnership at risk. So the most they can lose is whatever they've put into as capital for the business. Again, this is going to be reported as pass-through taxation on your tax return. So the profits that you take as a partner or limited partner are going to be reported on your income tax as if they were personal income and increase your personal income tax liability. And it does require, in most states, there must be a written partnership agreement in order to denote yourself as a limited partnership or limited liability partnership. And that partnership agreement has to specifically state who is the limited partner and who is the general partner that runs the day-to-day operations and accepts unlimited personal liability. And again, that liability has to be defined in the partnership agreement, which brings us to the LLC, the Limited Liability Corporation. This is becoming the most popular form of incorporating small businesses. It is considered a hybrid entity with traits of a corporation and traits of a general partnership or sole proprietorship. And there are various advantages and disadvantages to the LLC model. So one of the advantages is that it offers greater flexibility than sole proprietorship and partnership in distributing profit and is less restrictive than the S corporation that we're going to review later. So you can choose to either be taxed as a corporation or taxed as a partnership. So we'll talk about later why you might make either decision. Again, the members who own the corporation are going to have limited liability, just like in a corporation. So this is a separation of the personal unlimited liability that we talked about in the partnership or the sole proprietorship form. So the liability for the members who own the LLC is going to be limited to whatever they've invested in the company. They can't necessarily pierce through the corporate veil and invade the personal asset of the LLC members unless there's been some sort of fraud or wrongdoing. And again, the owners are going to be called members under the law. And generally, in order to form an LLC, you are going to have to do a filing at the Secretary of State's office in your state with the articles of organization for the LLC. We also have traditional C corporations, sometimes called a C Corp or just a corporation. And you're going to see this denoted in businesses when they have, Inc. or Corp or Core at the end of their name. This is more common for much larger corporations that are going to issue stock and have numerous shareholders that own the company. Again, this is a legal entity that is created under the laws of the state, which has its own privileges and liabilities distinct from those of its shareholder members, shareholder owners. And you're going to have to file extensive paperwork at the initial incorporation of the entity through your Secretary of State's office and also annually with your state of incorporation. The benefit of the corporation is that it has generally absolute limited liability of the owner shareholders, meaning that the people who own the stock certificates of the corporation only can lose the value of the stock or the value of the purchase price of the stock that they've invested into the company. People who sue the company cannot generally get the personal asset of these shareholder owners, meaning their home, their checking account, their savings are not at risk. However, the C corporation is going to be subject to what we call double taxation, meaning the corporation itself, as a separate legal entity, files its own corporate tax return every year. And the shareholders are going to be responsible for filing tax returns that include reporting of any shareholder income that they've received as personal income tax, subject to their personal income tax. So they're going to have to report dividends and profits that they derive from the corporation on their income tax return at the end of every year. And that's why we call it double taxation, is because both the corporation and the shareholder are taxed on their income derived from the company. This is a complex form of incorporation. So you might want to talk to an attorney, a CPA, to make sure that you're doing your legal filings and your accounting correctly. And again, this is going to be ongoing reporting and filings every year, sometimes quarterly, that you will probably have to employ a CPA and attorney regularly to help you with the running of your corporate form. And there's going to be complex ownership and management that usually requires what they call a board of directors in addition to executive management. So you're going to have a board of directors that directs the corporation. And then you're going to also have, executives such as CEOs, CFOs, presidents, vice presidents that are going to be members of or appointed to run the company by the corporation. This is appropriate for a few specific reasons that you should discuss with a professional like your attorney or CPA. And if those reasons don't apply to you, then definitely consider choosing one of the other organizational types that we've discussed before, or possibly an S corporation that we're going to discuss next. So we also have S corporations, sometimes also referred to as self-incorporations or closed corporations or family corporations. The owners, again, have limited liability of a corporate shareholder, but they pay income tax like a sole proprietor or partner. So again, same as a C corporation, except with the pass-through taxation. This is often the form that is chosen for family or closed small businesses where they want to have that limited liability where they can't pierce through the corporate veil and attack the assets of the individuals that are shareholders of the corporation if there's ever a lawsuit for the company, meaning they can't go after your house, your savings, your checking account because of debts or lawsuits of the company. But there are limitations on S corporations. It does not allow for foreign ownership or investment. Everybody has to be a citizen within the United States to own part of an S corporation. And often, many states limit ownership of S corporation stock to no more than 100 natural individuals, meaning other corporations can't own the stock. Real living people have to own the stock, and it can't be more than 100 people in the small S closed corporation form. And again, this is a complex form that you're going to have annual filings, annual accountings, and you're going to want to have to consult with professionals like attorneys or CPAs to make sure that you do your filings and accountings correctly. So after all of that, you may be thinking to yourself, which structure is best for my business? So there are some steps that you want to consider when determining which structure to choose for your business. So first and foremost, you should think about establishing a business plan. Think about the business, think about the form, think about how you want to grow that business, how you might want to run and operate that business. What do you consider to be your 5 and your 10-year plan for that business? Some things on the initial guidelines to consider. Are you going to be an owner operator? Is there more than one person that's going to be an owner operator? Should you consider a partnership? Are there multiple owners? Do you have a product with significant liability? If you have a product with significant liability, then maybe you want to choose one of the specific limited liability forms like the LLC, the SCorp, or the CCorp. Is it a large venture with multiple owners and complex financing? If so, you might want to consider the C corporation. Another thing to do, ask an attorney. Many attorneys do offer free consultations, free initial consultations, or something like $100 or $250 initial consultation. And it's a good idea to take advantage of that and talk to an attorney about your business form and what elements you might want to consider. And also, you can do your own research through your local small business administration website, your Secretary of State's office to look at the types of forms that you need to file for the various types, your county clerk recorder's website to look at the fictitious business name form, and the IRS website to determine what kind of accounting and reporting and financial statements may be required depending on which limited liability structure you might choose. So there's some food for thought, and thanks for listening in today.